Welcome to the 3 Edge Week in Review for the week of November 13th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. This week, Steve and I will be discussing the potential attractiveness of emerging market and Chinese equities, both of which have struggled thus far in 2023, and in comparison to the U.S. equity indices, such as the S&P, both Chinese and EM equities are significantly undervalued. We'll discuss why they have struggled and why they may be poised for a rebound. Before we get to our topic, let's take a brief look at the activity in the global capital markets this week. And there was more good news on the inflation front. The Bureau of Labor Statistics released a consumer price index for October, and it showed that inflation in the U.S. declined last month, mainly on the back of lower gas prices. And core CPI, which excludes food and energy, saw a year-over-year increase of 4%, and that's actually the smallest 12-month change in core CPI since September of 2021. Also, in economic news this week, the Bureau of Labor Statistics issued a report, and that showed that higher than expected weekly jobless claims may be a further indication of the potential softening in the U.S. labor market. And one other piece of positive news on the inflation front, the price of oil declined for the fourth straight week. So this recent economic data certainly seems to be strengthening the narrative among investors that the battle against inflation may be coming to an end, that the Fed will be able to begin cutting interest rates as soon as March of next year. So with that as the backdrop, let me bring Steve into the conversation here. And Steve, perhaps, I love this topic. It's a bit contrarian. So maybe first you could discuss why Chinese and EM equities broadly have struggled thus far this year and why they may be poised for a rebound.
Well, in fact, Fritz, they've not only struggled this year, but they've been underperforming substantially since the financial crisis of 2008. Now, even more recently, there are a number of emerging market countries that trade with China and are highly dependent on the Chinese economy to boost their own economies. And China has shown a lot of difficulty recovering from the days of COVID when they had that extreme lockdown. Right. And there was hope that there would be an extreme recovery, much like the U.S., but they've struggled quite a bit. Now, in parallel with that, they've had an over-leveraged real estate market and real estate bubble that some can argue is even more extreme than the real estate bubble we had in the U.S. back in 2007. So all of these factors have been inhibiting growth in China, and expected growth in the stock markets have reflected that both in China and in other emerging market countries that relate with it. And while some investors were hopeful that by now there would be some intervention or major stimulus packages, China has really held off on that until very recently.
All right, great. So now maybe let's dig in a little bit more into the details on some of the factors that our model research is picking up recently, which shows Chinese and EM equities to be potentially attractive asset classes at the moment.
So I think first we should begin with the idea of valuation. And markets can go to extremes because a lot of investing is more emotionally based. A lot of investors trade on trends. They follow momentum. If they see something working, they'll keep pushing it in that direction further and further, whether it's the up or down direction. We've certainly seen in the U.S. people pushing the U.S. market ever higher. Well, the exact mirror image or opposite has been happening with emerging markets in China. The underperformance has been self-reinforcing as well. And as people pulled out of markets that haven't performed well, they keep getting lower and lower. So now we have this situation where in valuation, we argue that U.S. markets have become overvalued. At the same time, emerging markets in China, as an example, through this underperformance has become substantially undervalued. To give you an idea, a statistic, one of the key measures, not the only measure, but one of the key measures we look at is a sign of valuation is the price to sales ratio. And we know from our past research, and we've talked about this in other videos, that if you can buy into a market when the price to sales ratio is low, it means you're buying in cheaply into the market. In the next 10 years of average performance are typically very, very good. If you buy in a market that's too expensive, it might keep going in the short term, but over the next 10 years, the returns are very bad. Well, we've seen the price to sales ratio of emerging markets, and I'll use China as an example, the MSCI index of Chinese equities. The price to sales ratio has dropped from a high of over 4 several years ago to recently under 1.0. This tremendous drop in valuation. So you can say that all the bad news perhaps has been reflected, whereas in the U.S., the price to sales ratio today is 2.5 times what it is in China, for example. And it's hard to argue that growth prospects in U.S. are 2.5 times better, or profitability is 2.5 times better. So a lot of that is this psychology. So lately, so valuation is one very important factor. Secondly, are looking at some of the economic factors that are in our model. They're showing early signs of potential economic stabilization in China after having shown a lot of weakness up until recently. And coupled with that are signs that the government is finally coming in with some more major stimulus measures that could form a bottom. Another factor is that when the Fed's been tightening tremendously over the last several months, and that's brought the dollar higher and higher. And all else being equal, when you have a Fed promoting tight monetary policy and you have a stronger dollar, that's not a good environment for emerging markets traditionally. Mm-hmm. And now, as you mentioned earlier in this video, that there's this hope that the Fed's next move is going to be a major cut, not a hike. And that could tend to soften the dollar. That's a great environment for emerging markets. So a lot of things are adding up that after a significant fall in price, investors running away from the asset class, that we could be a lot closer to a bottom than a top with some potential upside.
Excellent. Okay. So then my last question, as it always is, based on what we've discussed here about China, EM equities, what should investors consider doing with their investment portfolios in this environment?
So I think the first most important step is to step back and look at the big picture and say that even though there are some recent encouraging signs in the market, you mentioned several of those, and the idea that maybe we will have an immaculate disinflation, the Fed can drop rates without a recession, and we're off and running. That's not a 100% guarantee. And there is still a risk of a global recession. I don't think we're completely out of the woods. We still have yield curves around the world that are flat or inverted. And we all know from history that there's typically a big lagged effect from all the monetary tightening that can happen. We've had tremendous monetary tightening around most of the world. And perhaps we haven't seen the most negative impacts of that yet. So I think investors have to take a step back, recognize what their own individual risk tolerance is, and then first come up with an appropriate allocation to equities overall that makes sense for that risk tolerance. Once you do that, then you can decide, well, for that equity allocation, how much should be in which markets. And so we always have a core allocation to the world's biggest stock market, the U.S. market. But that's closer to our minimum allocation. In fact, it is at our minimum right now, not our maximum, given the fact that in our measure, the U.S. market is overvalued. And while it might keep going up in the short term, we know that in the next correction, if you're an overvalued market, there's a long way you can fall. Having said that, then the next step is to scan the investment universe to see, are there equity asset classes that are not only undervalued and maybe oversold, but poised for rebound? And so we've identified two this year. One is Japan and the other emerging markets. And those are contrarian investments because they've underperformed, but we do think we see signs that they can now have their day. And it doesn't mean they're going to go soaring tomorrow. It's not a short-term day trading type idea. It's more of a intermediate and longer term idea that just like an overvalued market will eventually fall back to its fair value, an undervalued market will eventually climb back to its fair value. Now, I do want to say one more point about the U.S. stock market. And there are some people that are showing signs of irrational exuberance and putting all their money back, not only in U.S. stocks, but in the segment of the market that's done the best, which is the NASDAQ 100 index, which includes a high percentage of those so-called Magnificent Seven stocks that have really powered the gains. So I like to show this chart, and it compares the NASDAQ 100 index this year, year to date, versus 1999 NASDAQ experience. And the chart will actually show the NASDAQ going through the whole calendar year. And we show this because, as we've said in earlier videos, you and I, Fritz, that there are a lot of parallels between some of the irrational exuberance and overvaluation we see this year versus a lot of similarities with 1999. And you can see this year, the market has been tracking quite like 1999. And so while if we continue to track, we'll see even more upside over the next few months. There's a warning, and look what happened after 1999 the NASDAQ 100 index. In this next version of the chart, you can see the extension, which shows that it fell 80%. And it was not expected. And it was all because the market kept getting stretched, kept rising on momentum, but it was an overvalued market. And that was finally a catalyst to bring it back down. So that's why we say it's better to be diversified. Look for opportunities for undervalued assets. Don't put all your eggs in one basket. And that would be my message for today.
Love it. That's great. Thank you. Great insight, and love the idea of the contrarian viewpoint. So that will do it for Steve and me for this week. As a reminder, our entire library of short videos is always available on our 3Edge YouTube channel. And if you think that someone you might know could enjoy or benefit from our weekly videos, please feel free to share them. In a programming note, since next week is the Thanksgiving holiday, we will not be doing a 3Edge Week in Review video next Saturday, but Steve and I will return the following week. So that will do it from here. On behalf of Steve and everyone at 3Edge, we want to wish everyone a happy and safe Thanksgiving holiday with friends and family, and thanks for listening.